My name's Dave DeBoe, founder of MoneyPartnerFormula.com, and this show is built for everyday real estate investors who are actively doing deals and looking to scale using other people's money. So if you're an active real estate investor and you want to get featured on this show to talk about your own real estate and capital raising experiences, then just go to daveinterviewsyou.com. Now let's get rolling with this episode, and remember to subscribe for daily interview content.
All right, guys, welcome to Property Profits Podcast. I'm your host, Bryce Kaminsky, filling in for Dave Dubow. And have you ever wondered how to effortlessly boost your income while holding down a 9-to-5 job? Today, my guest, Tom Cochrane, a seasoned real estate investor with a diverse portfolio spanning thousands of units. He's here to unravel the secrets of passive cash flow and mastering the art of vetting sponsors in an LP. Tom, welcome to the show. Thrilled to have you here.
Yeah, thank you, Bryce. Great to be here.
So as people on the video can see, Tom here is moving, so you have to forgive his jacket, etc., in the background. To the if you could see the other side of my studio, it probably isn't much better than Tom's background here. But let's get into business. The bottom line is real estate 101. How did you get started? What got you, thinking about it? What got you in the door?
Yeah, what got me in the door was I was actually back in high school. It goes back to high school senior year. I couldn't get a restaurant job. I could get a business internship. I worked for free at a construction management and they did property management as well as owner's representation. They've done like Dustin Hoffman's house and some other celebrities I can't just can't disclose. But yeah, that got me kind of a taste in real estate, and then been investing since 18, mostly.
Wow.
Been teaching myself the equities. I learned how to sell stock options, derivatives, and then real estate really became the hallmark when you look at, if we nerd out on the finance, right? Net present value, IRR, returns for adjusted for taxes. So that was definitely kind of a natural progression for me.
Like you went through all the other finance stuff and it led you to the answer that most of us get to, which is all wealth is either held or made in real estate.
Yeah, I would say that's dead on. Definitely had, definitely some key mentors to kind of show me the way. And, they've been big influences in my life. So, but yeah, I would say that's exactly dead on. I mean, just conservatively look at it doubles every 10 years. That doesn't even account for the depreciation and the tax advantage.
Tax advantages. Yeah, there's tons and tons of yeah, you don't get I think the main one that's commonly overlooked is the cash flowing passive tax deferral.
1,000%.
When I look at one of my business partners and his cash flow portfolio, it's like, oh, I lost money this year. It's like negative cash flow or whatever because of the interest rates. And he's like, that's great. That's going to be great for my other business because they're like, left or right. So
yeah,
it really depends what you want to do, but the asset becomes like something to play with in regards to, it's not just a stock or holding crypto. Like there's not that many tax advantages to holding cryptocurrency. I don't even know if there is. It's probably considered an investment, but there's really it seems like the tax codes are written to facilitate landlords and property owners.
Yeah, 1,000%. I mean, the tax codes are definitely there. I mean, even as limited partner, right? If you're just a money partner, you're not on the GP side, you're still getting, I can't give you tax advice, just got to give that disclaimer so I don't end up in a jumpsuit here. But you're getting mostly, you're not paying, you're using the depreciation. So you're not typically paying tax on the distributions in at least year 1, 2, maybe 3. And then if we refinance a deal, depending on the operating agreement, right, as a limited partner, that's not a taxable event. There's no tax. Yeah. So, if I put in 100 and I get 100 back, no tax.
Yeah. So, what was your first kind of entry into the real estate? You didn't obviously start at being an LP. What was it, like a single family? It was you said you started at 18. So what was tell us the story of the first.
Yeah, so started investing when I was 18. That was mainly on the equity side. It wasn't until, really 2020 that I did enough due diligence to where actually my first deal was a limited partnership on, let me just pull up, I got a spreadsheet here to cheat, 294 units. That was my first actual deal that I was in. And, if you just look at the forced appreciation through rent increases, you actually make more money over long periods of time, the bigger the deal is. And it's actually safer for the investor, assuming it's a good location.
Yeah, that's interesting. So a lot of people they're starting small. They're like stepping into it, single family rental, one unit, one family, one
Right.
their own money. And you went right to like 200 and something. Do you think it's because of your knowledge in uh kind of your risk tolerance when you look at the equities game that you were in coming into it? Because it seems like the difference between
Yeah.
small moves and big moves is always risk tolerance and like your self-belief that you can do it.
Yeah, I mean, it's a good question. I think, if you peel back the onion and you look at, two of the greatest risk factors, I think I took an academic approach to it from just decision making and logic, to be honest, and common sense, right? The
Mm-hmm.
occupancy is way safer in a 200 plus unit deal, so 294, let's just use that.
Mm-hmm.
So to me, the risk goes down. And if it's in a good location where there's demand drivers, if we're getting, if we think there's some rental growth there where it's below market rents, it's kind of a no-brainer at that point. I mean, I think the biggest thing to really talk about, Bryce, is a lot of people, and to no fault of their own, want to be the guy or the gal on the deal
Mm.
in what I call the sponsor, right? The person signing on the note, making the sole decision-making power.
Yeah, the one that
And
decides what kind of like laundry machines they're gonna
yeah,
replace them with. Yeah,
yeah,
real estate
exactly.
stuff.
Yeah, and I'm not hating on where anyone gets their start in real estate, but that was
Mhm.
definitely my first real estate transaction. Was a limited partner on a pretty big deal. Maybe definitely a little bit unconventional, but I just think the business fundamentals are so strong, right? But buying below intrinsic value, you buy on the purchase and you hold for long periods of time. I think it comes from maybe my Charlie Munger, Warren Buffett upbringing
Mm.
for long term time horizon there.
Yeah, and like and we were talking a little bit before the show. It checks your boxes as to things that you're interested in. So for people who are curious, I want you to go through that real quick again. We were talking about
Yeah.
how you define a deal so that people can get that headspace. So I think the first one is never lose money, Warren Buffett. Rule
Yeah,
number
yeah.
two,
So,
never forget
so,
rule
so the
number one.
yeah, exactly. That's rule number one. Don't lose money. That's Buffett. Rule number two is follow rule one. The implicit rules that Buffett, if you look at his doing this, uh, it will always cash flow.
Mm-hmm.
Okay, like no matter what. And then the other one is invest in good management. And if you're a limited partner, the management is the general partnership, right? Especially the principal or what I call the sponsor on who has the sole discretion, right? When to sell the asset, when to do certain things. And I think a lot of times the operating agreement is definitely going to be something you need to read every sentence of. If you're not doing that as an LP, I think that's ludicrous. And I think the operating agreement also needs to align those interests as well. Happy to kind of unpack that more, Bryce, but
Well, a lot of people, like for those who don't know, let's because we're throwing around a little bit of like LPGP stuff. So
oh yeah,
general
sorry, Bryce, that's my bad.
breakdown, and that's okay. It happens all the time. And not everyone is I think they understand. They just maybe they won't catch the abbreviation. So limited partners, these are typically the money partners. These are the people without decision making positions. And then you have the general partner, which is the GP, which is usually the people making the decisions on behalf of the limited partners. So
Yeah,
they're driving the deal. They're maybe on site. They're maybe in the same city, or they're managing the team that's managing the units and managing the building. So maybe they're overseeing the leasing office that's managing the building. A lot of times bigger units and stuff have their own leasing offices and things like that. So they're managing, making sure it's profitable. And then the LPs, I guess, are then choosing these GPs, or the GPs coming to LPs, and they're coming together in sort of like a marriage. There's money and people willing to do work for the money. And then they come together and a deal is made. And so are you finding, so it's really interesting for me
yeah,
as you're a person who's a limited partner, you spend time on the limited partner side.
that's right.
Do you ever wish you were on the GP side?
Yeah, great question. I think now that I know what I know now, I think I have more confidence on, hey, I can do a napkin underwriting really fast. I know if it's a good deal or bad deal pretty quickly. So I definitely have some goals that, I have personal underwriting goals on how many deals I want to underwrite in certain locations and markets.
Mm-hmm.
I definitely am working to, in this year, slowly move to the GP side. And just to kind of elaborate on what you said is, there's different roles on the GP side. There might be someone who's underwriting, there might be a capital raiser, there may be someone doing the boring nitty gritty stuff, working with the lawyers,
Mm-hmm.
getting the depreciation. There's a lot that goes into a real estate transaction past kind of what I'll call like the managerial
Mm-hmm.
discretion of the sponsor. So yeah, I definitely would love to get on that side long term and you know, definitely playing the long game. I'm 30 years old, so I think, just knowing that that's where I want to go and getting kind of more into that active bucket would be definitely the long-term vision. And I'm okay if there's another person who, I'm on the GP side doing, even maybe the grunt work, to be honest, to start. I'm totally fine with that.
So how much because the limited partners are getting pieces of the deal. And so how many partners, how many pieces, what percentage of that deal, if you don't mind me asking,
Yeah,
because some
yeah,
people
go for it.
don't want to disclose that or they don't care to. How much of the pie does an LP actually take home when it looks at something like a 200 and I think you said 292 unit deal, right?
Yeah, yeah, yeah. So I'll just tell you kind of the basic structure because that's really what decides your take home. That deal specifically, I'd have to go look at the papers, but I think it's anywhere from, I think it's just a simple split.
Mm-hmm.
So it's, cash flows. So I think the cash flow split, I want to say it might be 75-35
Mm-hmm.
if memory's holding me correctly there. Sorry, that's bad math here. I think it's 75-25 maybe. And the
Mm-hmm.
limited partner gets 75, and then the general partner gets 25. And then in the event of a refinance or sale of the asset, the limited partner gets the return of capital first,
Mm-hmm.
and then it's split in the same like partition. So I think the simple
So
splits,
how
yeah,
many LPs are along that ride with you in that deal? How many other investors? Like, did you go and put them all together, or is it just your capital
yeah,
in that deal?
yeah, good question. No, no, in that deal specifically, as you can imagine, the size of the deal, I mean,
Mhm.
uh, the equity alone on that specific deal was around 7.7 million. So, I mean, when you get to that economies of scale, we're
Right.
talking, we might have, I don't think I know the actual number. I think the sponsor would know that, but
Mm-hmm.
I'm sure there's north of, hundreds of investors in that.
Yeah, like a REIT would have been putting some money on that, and then because the capital raisers work really hard in the GP section, because there's people who are like deal
Correct.
finders, and then there's people who are like capital raisers, and then they connect with these limited partners and try to put maybe 100 people together to get $10 million
Yeah.
to bring to the bottom line to actually close on this thing. Now, with the interest rate environment that we're seeing these days, is that affecting your numbers as an LP? How are you guys managing that? Because typically, like, how
Yeah.
many
Good
years
question.
ago did you buy that, and are you now experiencing the pains? Like, some people are running up against the fact that they bought it with a interest rate in mind,
Yep.
and typically you're using bridge financing until you get to the mortgaging event or a refinance event, and then now things are changing and people aren't either able to get traditional financing or the numbers aren't playing out. And how does that affect
Yeah.
the limited partners instead of the general partners are just trying to their best? But how does that affect an LP when things don't go the way that they're supposed to?
Yeah, so that deal specifically was around during, the COVID era, right?
Mm-hmm.
And so it comes down to back to good management and financial fundamentals. We bought, intrinsic value below what it should have traded at, to just be
Mm-hmm.
honest. And people, they're looking for financial distress. That's where you're looking to, what I'll say is swipe the asset for a lower,
Well, you're
basically,
trading equity for problems. People are always looking at it funny, like,
yeah,
economic distress, and people are selling things off, and we're like stealing the deal, right? We're stealing the deal, but we really
yeah,
want
go
to
ahead.
focus, especially for people who are acquisitions, and
Yeah,
when you're buying something below market, it's because people are trading their equity that they could hold out for if they could hold out for it for the problem being solved. So we come
correct.
in, we solve a problem for this apartment owner, and he gives up equity in exchange, and we're able to get a better deal because he can't wait around to exercise his equity. He can't get out of it. It's in a bad position. He's in a bad position, whatever.
Right.
And then we exchange equity for problems. So never in this world can you steal a deal unless, and lawyers usually shut that down quick. Like if they see something on paper that looks too good to be true, we've had it happen a couple times where wholesalers bought too low, and the lawyer steps in and says, "Nah, man, you're stealing this house." So
Yeah,
there's like a reasonable equity exchange for problems in the world of real estate, and that's usually where deals are made, when someone's willing to give up equity because money is less valuable than a problem solved.
yeah, I think that's spot on. And especially, in the larger commercial space, you're also seeing partnerships might break up. It could be their
Mhm.
financing reasons. It could also be someone's been holding it for 30 years, it's paid off, and they died, and someone's inheriting and they're selling it. So there's a few reasons where, you're able to get these moments. And, really, you have to go look at, maybe 100 deals before
To
you're
find those. Yeah, it's
finding one deal.
the four deals: death, downsizing, divorce, and
Yep.
debt.
Yeah, there you go.
So
Divorce is the other
business
one. Yeah.
divorce, yeah, business divorce.
That one's probably
Long-time
less
owner
common.
dies.
Yeah. Oh, sorry. Go ahead.
Oh yeah, I was just gonna go through them, but yeah, I mean, I think what was really interesting that you keyed on to is, and this probably happens in multifamily a lot, is maybe not a lot, but business partnerships becoming contentious,
Yeah.
and one person wanting out, and because of their structure they have to like collapse the deal and sell because the one
Correct.
person can't navigate the replacement of the other partner.
Yeah. Yeah. You're exactly right. And that is dead on. I would say I was just going to chime in on the divorce piece. That probably happens less in the commercial space of the deals I'm looking in and wanting to invest in. Anything,
No, it's
no.
a business divorce. It's going to be a
That
business
you're
divorce.
exactly
Yeah.
right. That would be the divorce. You're exactly right, Bryce. And then the other thing that on this downturn is there was two deals that I'm in that were bought on adjustable rate. Okay.
Mm,
And that's,
yeah.
everyone's like, don't ever do that. Most of my deals that I'm in are long-term debt. So I feel like it's very stable. That one I'm a little bit more, that's taken a slight cash flow hit, but the business plan on raising the rents, we have exceeded all the upside already. And I haven't even been in those deals for, 2 years. So
Yeah. So it's that's the other thing is, sometimes people are buying multifamily that's like kind of turnkey, and unless you're buying like quite a bit of equity, especially with the rates, it may be that you can't find lift. And that's one thing that I've noticed as someone who's in the acquisition side of
yeah,
single families and multifamilies is, typically investors are looking for lift. And if there's no inherent, like, they're like, oh, can I add units? Can I da da da? And if there's nothing like that, then a discount is typically not enough unless it's huge. And there's got to be some, like, it almost seems like that multifamily investors, I've only ever like assigned them, they always want a projecty kind of nature to it. Like they can't just be happy
right,
that it's a
right,
nice building that makes money. They got to be like, what else can I do with it? Like they're just always hungry for the lift. And if there's no lift and it's just beautiful and working,
right.
well, that's almost harder to sell than something that needs work.
Yeah, I would say that's true. Mostly there is some room on the deal, meaning area of improvement, to your point. And usually sellers and brokers, because the brokers are selling these deals. So you want to always do that. And there's always typically room. And then going back to the splits earlier, I just want to make sure the audience knows That was one of my earlier deals. Since then, most of the deals I've been in have been like an 80-20 split, same terms. Another one recently has been they have what's called a pref or a preference. That means no, all the cash flow up to X percentage. This one happens to be a 6%, goes to the limited partner first, and then it gets divided on the split. That one's also 80-20. And then same thing, return of capital first before splitting on the upside. I think another key thing I want to make sure the audience knows, Bryce, is if a sponsor is going to remove you from a deal when the deal is refinanced, you do not want to be in that deal. That is something that, I just want to make sure,
Yeah, because
I
I
can't,
would
yeah, go ahead.
imagine like my feeling on that would be call a hard money lender then, because because if you're trying to be an LP on like a long-term play,
Yeah,
it has to be a long-term play, and it's not 5 years, because maybe they fix it up and refinance it under 5 years, maybe 3 year, three or
correct.
something. They get all the lift, and then they're like, and then we're gonna refinance all the partners out, and we're gonna own it ourselves. And it's like, that's cool. Um, but if you're someone who's looking to build wealth, like you're talking with the Warren Buffett philosophy, that's not going to fit that business model, because you're trying to also get the long term equity. So you're trying to be on that thing indefinitely, not refinanced out, because most of the money, if I'm understanding it now, granted my experience in that is very limited, most of the money's after year 5. I think that's a basic thing in buy and hold, is like for 5 years, it's not going to be awesome. But after 5 years, it gets better. And
Well,
after 10
but
years, it
that's
gets even better.
Yeah, yeah.
So,
I mean, it can be some of these partnerships I'm in, right? Or deals and structures or funds, and some of these are funds to where a fund will go buy 2 or 3 deals. So
mm,
I like that as a limited partner too. You typically have a more senior operator or sponsor doing that, but 5-year period, some people have what I'll call a soft target to sell the asset then in a
right.
5-year to 3-year period. But if anyone also has, if any manager also, I'm just giving you some of my definite red flags. If they're forced to sell at a certain point, run away, never sign the contract. Do not send them a dime, go the other way. This is just educational. I can't give you investment advice.
Mm-hmm.
Again, just putting
That's
that.
just your experience. Like your experience is that that's not a great deal to be in. It doesn't facilitate long unless you're really into that. Like, what if I just want to be
Yeah.
in for 5 years? Should I
Oh,
sign
oh
then?
no. That I would say that's fine, and we can make a financial spreadsheet case to where we're actually saying your internal rate of return's better, which means adjusted for the time value of money, you would create a greater return. Now, on a tax adjusted basis over long periods of time, that's
Yeah.
a separate discussion. But parking that for a second, I'm
If it's
fine.
just
I
cash in 5 years,
Yeah,
because that's really, I guess, the tax deferral when it gets into 5, 6, 7, 8, 9, 10, 15, 20 years. Um, there's advantages to playing long term in that sense. But cash on cash at the refinance event, maybe you get a windfall or a balloon payment, you're out,
yeah, it could
something like
be.
that.
Exactly. So yeah, I'm not opposed to, I'm in only one deal right now. Most of them are long-term buy hold. I think that's the long-term, that's the not sexy play.
Mm-hmm.
Everyone is kind of chasing this, big shot in the arm, so to speak, on, oh my God, we got a 20% IRR or what, 15%. But
Mm-hmm.
remember, the tax man, the IR and the S, they're going to come in and just take a big woof out of you, even if you redeploy the capital right. Not to nerd out on the tax side, but I think I'm in a few deals to where their target is to sell in 5. I just think for a limited partner, if the sponsor says we have to sell in 5, they don't know what they're doing, run the other way, because no one should be forced to sell, right? If the interest rates are terrible, if they can't get a good offer, you don't want them to sell. And they might want to refinance and hold the asset because you have a smoking deal where it's already paid you back and some. So I just think you want to have a little optionality there for both parties, whether you're the sponsor or the limited partner.
So when it comes to this real estate investing, what do you think your secret sauce is? What comes easy to you that other people find difficult to do?
Yeah, I mean, I think, speaking for just a 30-year-old here, I think one of the things that's been successful for me is flexing the muscle of investing over and over and over again. And, I jokingly will tell people that are trying to, hey, how did you get started or whatever? And maybe on the limited partner side, vet the sponsors, read the operating agreements, right? Look for the couple things I spoke about. And also, honestly, after that, and if the operating agreement checks out, and by the way, you're buying the operating agreement as a limited partner.
Mhm.
That is the legal contractual agreement you are purchasing. Okay, that's not legal advice. Just I got to put that aside. I don't have a JD. Okay, but that's what you're getting. And I think a lot of people don't understand. After that, sending money and sending it in, whether it's a wire, a commitment, a subscription agreement, that is the hardest part, right? A lot of these people maybe have this la la land. Not, I'm not hating, but some people have that on financial freedom and all that, but they're just not willing to do what I consider blocking and tackling, right? If you ask someone in fitness, it's your diet, steady state cardio, and loading your bones and muscles, right? In real estate, it's you first need invested capital and you need to deploy that capital. And also, you need to be patient. For me, I've been patient on finding sponsors to get into deals with. And, I have a very strict criteria on that. Sometimes I'm interviewing 12 people, I'll throw 12 in the trash altogether. Maybe I'm lucky I get one out of the 12. So, yeah, I would say it's
Yes.
definitely the long
I
game there.
I always say it's everyone's, especially early on, depending on what like your strategy is, but it's like everybody wants to talk about doors and deals. And once you've been in the business 5, 10 years, you
Yeah,
realize it's not about the deals you do, but it's the ones you don't do,
correct.
that actually make profit, because it only takes, like you could have 7 or 8 good deals, and one deal sideways can trash all of your gains. Like you could easily
Yep.
trash all of your gains. So to like rush into a deal because you're like hungry for a deal, and maybe you're like your LPs when you're looking at your GPs and you're like hungry to do a deal. Well, it's kind of like the guy, at the bar. He's like picking up whatever because he's hungry.
Yeah.
He doesn't want to go home hungry, right? So he's taking
Right.
whatever he can get. And so don't do that. Everyone at home, don't do that. Wait it
Yeah.
out. Because it can cost you more than doing, 9 good deals, and one bad deal can cost you all the things. So do you like to find deals and then bring the money to the table, or do you like to get all your money together and then go looking for deals?
Yeah, it's a good question. I mean, I've definitely been. It's interesting you asked me today. I just had someone bring me a deal that I might help with. So, I can't talk about that one because we have things signed, but I would say more commonly than not, it's me getting some money together first and then going to find how to deploy the capital. Now, as I move from this side, which is the limited passive side, onto the other side, it's going to be a little bit of the opposite, right? Now we're looking at deals after deals after deals. And to your point, like if we look at 100 deals and we find one deal, like that to me is a good yield. And that might sound crazy to everyone going, oh my gosh, that's insane. But the other thing is you need to go ask the sponsor or a general partner if you want to be in these bigger deals. You need to ask them, how long did it take you to close on your first asset? Okay, because that shows their patience and discipline. If it was under a year, I'd almost run right away
Mm,
because I know how long it takes to find a good deal because I've done some underwriting on my own. Typically, it's going to be longer than a 12-month cycle. And you said it better than I will, Bryce. You don't want to be in a bad deal. I rather have my money expiring in the bank, depreciating in value with inflation in the bank than deployed in a bad asset where you could lose everything.
yeah. Well, and just like that, whenever I'm talking to like acquisitions people, I say, look, if you're in the single family, you're in the like duplexes, fourplexes sort of business, that moves quick. You find a deal, you move a deal. You find a deal, you move a deal. If you want to play with the big boys on the big deals and the big blocks,
Right.
don't be surprised if you spend 8 or 9 months doing due diligence for it to all go into trash because it actually wasn't a deal. So like you got to have patience in the multifamily space. you know, and I think that's why people are jumping on GP and LP, because there aren't a ton of deals that are good deals, but if they can partner up with people that are working on good deals, it
Yeah.
can help you get into that business, because there's a lot of non deals that are floating around that without an education or without due diligence. And that's why you got to like take the time and like underwrite that thing and really dig it in. And, you know, as I always say, buyers are liars, sellers are liars, you know, especially when it comes down to like, okay, let's look at 292 rent rolls and, oh, let's see what their payment history, like, is this thing actually making it any money? Oh, and the water and heat expenses have like zeros
Yeah.
at the end. Like no water bill on a building like this is going to be, you know, whatever, 50,000 even. Like, okay, now there's some red flags. Like there's things that you got to dig into, and it might just collapse. The deal might collapse. So don't be surprised when you're hunting deals, putting these things together, that 9 months down the road, it collapses. And so I always say, you know, put a new one on the pipe every month, because you might, if you just focus in on one deal, you might blow your whole year on nothing. So you got to be like constantly doing both, raising capital, typically raising capital to be ready to move when something good comes, but also vetting deal after deal after deal after deal. Because if you just get suckered into one thing and you spend all of your mental energy, I think that's the biggest thing, effort versus energy. You know, like I always say to acquisitions guys, like tennis, and maybe you can speak to this a little bit, like tennis, get some information, get what you need out of it, and send it back to the other party, and stop thinking about it until they send the ball back over the net. That's the only way I've seen people be super effective in deal hunting, is like,
Yeah.
don't let the ball sit on your court, figure it out real quick, and send another query out for more information. Send it back, send it back. Otherwise, you're just going to be like ruminating on this thing. Like, how do you play that game?
Yeah, playing that game, when I'm underwriting and maybe trying to find deals, I'll speak to that side and then the passive side. But when I'm trying to find deals, I'm trying to get to know as quick as I can. I want to get to a no within seconds. So I'm just doing napkin underwriting, and then I'm finding out what I would be willing to pay for it. If it's in my zone and I'm comfortable with the location and I have enough structure, you could just submit an LOI, letter of intent, to the broker. And
Yeah.
then, but before then, you might want to ask the broker, hey, why are they selling? You always want to know why they're selling. And then the second question to that, and you want to make sure to get an answer to the second one, is what happens if they don't hit their number?
Mm-hmm.
Because if they just say, oh, then we're not selling, you don't even have a deal in the first place. To
Yeah,
Bryce's
they're
point,
not that
right?
they're not
No, there's no
willing,
deal.
they're not willing to trade equity. That's why instead of
Yeah,
asking why they're selling, I'll ask, what's the story with this thing? Because the
there you go.
story is
Yeah,
different than like if you ask someone like, hey, what's the tell me about this house, they're going to tell you about the square footage and, you know, the furnace and the hot water tank. But if you call an agent, you say, what's the story with this house, they'll be like, well, the old man's got to move, and daughter doesn't want the house, and she lives in, you know, what, the West Coast. And it's like a story. He tells you the whole story, and then you actually find out like why they have to sell. And I like your second question, which is huge. You're taking notes at home. What happens if they don't sell? And if they say nothing, then there's probably nothing there, because they're just feeling the market.
yeah. A lot of these folks, especially in commercial, you know,
They
if
might be
they're
listed
not,
for 10 years.
yeah, yeah, maybe not that much,
Well, no,
but
I know of
oh, really?
commercial deals that the guy has had passively or
Right.
actively, depending on the vendor's motivation, the
Yeah.
seller's motivation, posted and then withdrawn a bit and posted, like actively but passively selling it for 10 years. It's not a deal. It's not a deal if
1000%.
it's
It's not
been
a
clicking
deal.
around, because there's no trade of equity.
Yeah, and there's also no urgency. If there's no urgency for the seller, you as the buyer are not going to be in a good position. And by the way, if they say we'll just keep it, I'm going to be like, okay, would you give me terms then? Then I'm just going to
Yeah.
switch it. If they're not going to budge on the number, maybe I can use seller finance. Okay, I'm getting a little in the weeds for probably some of the audience, but
No, that's good. I always say terms or capital, right? If you can't get the price, you can't have both when you're buying deals. It's either price or terms, or maybe a combination of two. But if they're not going to move on the
yeah,
price, then it's got to be pure terms and they got to be great.
yeah, and then I'm only going to be able to make sense of the deal when, I might have a seller finance balloon, and, I'm going to probably anchor the negotiation, pretty aggressively there, 5 year, 7 year.
Mm-hmm.
What's in it for the seller, by the way, you're going to pay them every single month
Yeah, you're going to turn
in a
their
seller
building into
finance
like a
scenario.
passive income stream for them. Well,
Yeah,
semi-passive.
and they get to defer some of the taxes. I'm not claiming to be any seller finance expert, but that would be the only other final thing before you move on. But
Yeah.
honestly, if a broker tells me, and you only should deal with a commercial broker buying commercial real estate, and he or she has to be the listing broker. Never use another broker to buy it. You only want to use the seller's broker always. That
Well, it
is,
shortens the purple monkey dishwasher, right? You don't have to go like, hey, 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 and then he goes, hey, 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 and then the next person, it's like four people goes from you to your
yeah,
broker to their broker to them to them to them and back and forth. That's why I agree. Always go. I even do that in residential real estate because I don't
there you
want
go.
who has the answers.
Correct.
The listing broker has all the answers, and
1000%.
your agent's just gonna have to go and get the answers from him, and maybe he even doesn't even ask the question right. So just go right to the listing broker and
Yeah.
shorten your headache.
Yeah, I agree. And then, one of the questions I'd love to sneak in is once you get the broker kind of open up a little bit to tell you the real deal. Uh, and by the way, those calls should be quick. I'm very quick to move on. Next, if it doesn't fit, throw it in the trash. I think so many people get hung up on, oh, I love the location. Oh my gosh, the curb appeal is great. There's no shortage of deals in this planet. So it's just, time under tension. Same thing at working out. You need time looking at large volumes of deals. It's
Mm-hmm.
really just like sales. You're going to call thousands of people to get a number of deals done. It's the same, but you want to ask the broker, what don't you like on the deal?
Mm. See
And
what he thinks
and if
is
they give
great.
you, yeah, if they give you a BS answer,
Oh, it's
meaning,
perfect. I love this. It's a great deal.
and you're ready, I would just say, I understand. What don't you like? If I'm your nephew, what don't you like on this deal?
Oh, I love everything about it. I love everything about it, Tom.
Yeah,
Sounds like he's
I've
selling, eh?
I've never gotten that response personally, but
Maybe I should be a commercial broker and just always say nice things. Yeah, sounds like a great deal. I like everything about it. Well,
yeah,
and you start picking at it and be like, yeah, it's not perfect, but I still like it. Now all of a sudden I'm selling deals like crazy.
right.
Just joshing. So
Yeah,
we could go
absolutely.
on all day. I think the real
Yeah,
thing
go ahead.
is that people are going to want to connect with you directly, Tom. So if people want to
Yeah,
connect with you, they want to find out more, they want to, learn a little bit more about your strategy and how you've been able to do what you've done so far. What should they do? How do they find you?
yeah. And it looks like I had an egregious typo here in my little thing here. I can't spell family, so on Instagram, it's Cashflow Multifamily
Mm,
is going to be where you can find me on Instagram. Feel free to message me. Happy to set up a call to help you in any way I can. Whether that's you're a sponsor looking for a young guy like me, or you're trying to just get more information. I'm happy to help in any way. Please let me know.
awesome. Well, I really appreciate you stopping by, Tom. And until next time, guys, we'll catch you on the next episode.
Hey there, I really hope you enjoyed that episode. And as always, if you want to listen to more daily interview content, make sure you subscribe. And if you're an active real estate investor and you're doing deals and you'd like to get featured on this show, then just head over to daveinterviewyou.com. Now at moneypartnerformula.com, we help real estate investors to create a process for predictably getting capital so they can do more deals without relying on hard money lenders or the banks. We do this by building them a private capital marketing system. Now, if you want help turning yourself into a big money capital attraction machine, then book a call with our team to see how we can help. Just visit moneypartnerformula.com to find out more. All right, take care, and we'll see you on the next interview.